would be good is talking to people like running for president and tell them when to run or not, okay? People acting like suddenly Kamala's going to get things and do all these things, or Trump is going to cut all this by 80%. Not gonna. This isn't an election to win, especially not for the incumbent. In other words, Trump would do better in this scenario if he wins and the economy crashes, as I'm saying, right as he's walking in office. There's no way you're going to blame somebody that just walked into office, okay? Franklin Delano Roosevelt didn't get blamed for the Great Depression. He walked in well into it. Ronald Reagan didn't get blamed for the early 80s recession. He walked in when it already just started in 1980, okay? So that's the person who gets favored. And then it only takes 2 to 3 years to turn around the worst downturn, i.e. the Great Depression. And so by the time re-election comes up, whoever does win this election, either one of them, will look good and probably get reelected, but particularly if it's a new guy, Trump, that comes in. Now, Trump cannot run again. Now, Kamala is kind of in the middle. She's not Joe Biden, but she was her vice president, so she's a little more attached to the incumbent. If suddenly she walks into office and the economy goes down, well, people will blame Biden, which means indirectly they'll blame her to some degree. The problem is he's not responsible for this, okay? This bubble, the Federal Reserve and central banks have cranked up this bubble around the world. And, Biden didn't tell them that they like them to crank it up during their term, but they're not in control of that. But people will still blame. So I would not want to be elected if I'm Kamala or Joe Biden got pushed out, but he's going to thank God he got pushed out, okay? He's the guy that would have looked the worst if he'd have won, and then while he's getting increasingly senile, the economy gets senile faster than him. The sunspot cycles are like, 11 years on average. They vary some, and sometimes get a little longer or not, and you can track that. They affect business activity more. When the sunspot cycles are high, you're more likely to get higher value. Valuations, I'd say they affect to some degree, but they don't affect the economy like these. The two things I track, a 39-year approximate generation cycle, which I can measure exactly how many people are going to move into peak spending from a generation. And the technology cycle, you get two bubbles or booms and busts in a 45-year time frame, like the bubble into 2000 and the bubble into late 2021. Those were, 21 and a half years apart, right? About that half of that 45-year cycle. So those are the two reliable cycles that I can predict and have the most direct impacts on the economy, way more. So I have a whole wealth of knowledge on cycles, but these two cycles are the ones. And when you're in bubbles, the bubbles always come from the 45-year innovation technology cycle. That's what bubbles up. It's the tech stocks that lead bubbles, not the, Johnson & Johnson's. That is a layup. More energy is falling on everything from plants grow faster. People feel more energy. People go out on this beach to soak up what? Energy. They're sitting there doing nothing, relaxing, soaking up energy. So it is literally more energy or less energy falling on everything on Earth. So that's an easy one for me to say. It's an indirect. Doesn't mean people go out, oh gosh, I'm hot, so I'll buy a popsicle, although that happens. But I can understand that. This would be a bigger cycle I track. It's not anywhere near the impact of these other two cycles I'm talking about. Inflation is not going to be the outcome of this. It's impossible. An asset bubble, when it deflates, it takes money. This is money that's been created. Money comes out of thin air already, but financial assets blow that even more. When financial assets deflate, again, biggest number in the world is 630 trillion in financial assets, 6 times the GDP. That's what's going to happen here. This is not a normal downturn where businesses overexpand and they lay off workers and that causes more layoffs because it's, It'll be that. This is a whole nother dimension, and that's what was different from the 30s depression and the 70s long recession. So that's what you got to think. What you got to worry most about, your job second, you got to worry about your financial assets, real estate, and the stocks and things like that you own. Anything that's financially valued has been blown up to at least double its value. Stocks more so, and real estate has to correct. I used to say 50%. Real estate's gotten the point to just get back to where it was before the bubble started, and that's in 2012, okay? That's at the last correction in real estate. That's not that far back. Stocks have to go to 2009 to get back to fair value. Real estate just has to go back to 2012. So you look at I tell anybody in this audience, look at your real estate. If you can determine what it was worth, let's say in the middle of 2012, give or take, that's your potential downside Are you comfortable with that? If it's 20%, most people be comfortable with that. I'm telling you, it's probably going to be 40, 50, 60, 70% if you study every bubble in history. South Seas bubble was the first one, okay? It went up from 1 to 99 and all the way back to where the bubble started at 1. Bubbles erase themselves and then start going back up and normal. In other words, they erase more than they should, because just as they go up more than it's worth, they also end up going down more than they should. So that's why bubbles are so treacherous. 2009 is where bubbles would have to go to erase themselves for stock. That's when it started. And I look at 2012 for where real estate would have to go to erase its bubble. It can be different areas, but that allows you to look at different real estate. Real estate's much more varied than stock. There's a lot of real estate that won't go down that much. You don't have bubbles in places that aren't growing already. You don't have bubbles in depressed places. The new technologies are where the bubbles are. This is the new high growth stuff. So bubbles aren't random either. They come where there's very high growth, and human nature is to overreact to everything. We oversteer, overdo everything. Things get good long enough, we get overly positive about everything. Things go down long enough, people say life will never be the same, we'll never come back, blah, blah, blah. My kids will never get good. People overreact. That's what we do. We just overreaction machine. Crypto bubble, literally, when a speaker got up at my own conference and said it's about the digitization of all financial assets in the world, I'm like, I get it now. That's huge. 630 trillion. Even if you just 10% of that is huge if you can improve it. So that's when I got that this is a big thing. So AI is also a big thing, but AI, I was talking about this in my Roaring 2000s book in 1998. I called it the automation of management and professional work. We automated farm work and then factory work. And then we've automated everything in the office, bookkeeping and all this stuff, automated computers, simple left brain stuff. Now we automate professional and manager. 80% of what lawyers and doctors and all these people and high-level managers do is automatable too, okay? Anything left brain is just more complex, but anything left brain. So now we automate that, and that brings a whole nother revolution, because that's where the highest costs are. And the people, and more of us are getting higher education and becoming these professional and managerial people now that we've automated everything else. So we're always automating the present jobs, and that opens up people to move into new, higher human, creative. We're going to have to do more and more creative right brain work, because computers are left brain machines. Anything left brain can eventually put in a computer and be done at a fraction of a cost at the speed of light. That's what you're competing with in anything left brain. Gold is in its final bubble. Gold last time bubbled up with everything else. All the gold bugs say, gold's going to be the savior in the downturn. No, gold ended up going down in 2008, not as much as stocks, but it went down in the end. And this time, gold has bubbled up way more. Gold will peak here around 27, 2,800, wherever it does. And when things crash on a lag, gold will end up, its support is around 1,100. That's a big crashing. That's maybe a 50, 60% crash in gold. And people think gold is going to be the safe haven. It won't be the worst place to be. But I'm telling you, in 2008 proved this, in the end, it will not be the safe haven. Treasury bonds are the safest thing on earth, despite our massive deficits, because everybody has bigger deficits than we do, and we're still the lead dog. There's very little inflation now. In my scenario, inflation will be 0 to negative. It was 0.4% in the last crash, in 2009. So inflation is not an issue. Treasury bonds are the safe haven. They went up 45% when gold and stocks and real estate and everything else went down, and commodities and stuff. Treasury bonds were the one thing that went up 45% in 2008. And then there was time to sell them, because that was just a safe haven play. I mean, who wants a 2, 3, 4% yield long term? I'm looking at Bitcoin, because Bitcoin will tell you when to expect stocks to go down. It's very hard to predict this. Stocks don't want to go, nothing wants to go down. Nobody wants this bubble to burst, let alone the government and the Federal Reserve. So markets have to get bad enough on their own to start to trigger fear with investors, and then they start thinking differently. They can crash. It's got to go down about 40% just to get back down to the late 22 low. See, that's when you realize 40% crash is just going back a year and a half. Yeah. Whoa, that means you had a really big bubble to go that much to have to crash that much. So Bitcoin, that's why I'm saying you got to be cautious here, because when this happens, it's going to come fast. The 22 crash came fast. This will come even faster than that. They did raise interest rates 525 basis points, and they cut that 9 trillion bloated balance sheet, 2 trillion almost, okay? That is big tightening. And that will take a year and a half to hit by past analysis. And that's why I'm not going to judge how much it's going to impact fully until the end of the first quarter of next year. And then I'll say, okay, now we know what we're dealing with. And I am expecting the economy to be significantly weaker by then. Stock market's always ahead of that. Bitcoin tends to be ahead of that. Why I'm looking at Bitcoin now and Bitcoin peaking and dropping. So I want to be ahead of it, and I want my subscribers to be ahead of it. It's that simple. I want treasury bonds, the longest duration, which is 30 years. So if you're buying a treasury bond, the longer the duration, the more the deflationary multiplier is going to happen for you. I'm saying that a 30-year bond will more than double if I'm right about this downturn being 50% deeper than the last one. Normally, it would be impossible for a safe treasury bond to double. We already saw the 10-year bond go up 45%, not the 30. That was probably 65, 70. 10-year bond went up 45% in the 2008 crash in less than a year. That's what I'm looking at. This is your safe haven. Peter Schiff's going to tell you to go under. He's going to be right about this crash. He's going to be wrong about it sparking hyperinflation. It's only going to deflate when these financial assets go down. But nobody could print enough money to beat the financial deflation crash. I'm just telling you, almost impossible, or you'd look like an idiot and be shot, okay? The crash that deflated the last big bubble in history was 29 to 32, and that caused the deepest deflation and deepest unemployment and the biggest stock crash in all of modern history, and this one should be worse, if anything.